We've seen a major correction in high quality, high growth companies in Australia, particularly in the small mid-cap area of the market. And we want to tell you why and give you an understanding of some of the anomalies that we're seeing. What we've seen over the last few years is a lack of growth in the banking sector and the resources sector. These two sectors make up about 50% of the benchmark or the index that most large cap managers pit themselves against. So what we've seen as these large cap managers is move into the small mid-cap sphere to get some growth and to get some share price performance and some performance within their portfolios. What we've seen more recently is a big performance from the resources and banking sector, and many of these large active managers are looking to close those underweight positions in banking and resources. So it's clear that they have to sell some of these small mid-cap stocks. Now the problem here is they're fairly illiquid and they are in very, very high multiples. There's some companies out there on multiples, PE multiples of 40 or 50 times as a result of what's happened over the last few years in terms of large cap managers moving into them. So as they're moving out now, we're seeing major corrections, 15, 20, even up to 30% in some names. So you have to understand why it's happening, that it is an unwind from large cap active equity managers, and it doesn't say very much about the fundamentals of the underlying company. So we think there's going to be opportunities presented. You have to wait until the turbulence and volatility subsides, but we're looking at a number of companies that have got terrific businesses that we've always balked at the price that we had to pay. We could never get the valuation, but some of these companies are now looking at fair value and in some cases cheap. We always wonder how we get a good quality company cheap, and it's normally in circumstances like this when there's a rotation of capital out of these sectors by large managers. So the high PE do rate that we've seen, we're probably 3/4 of the way through it. There could be further pain to come and volatility, but now's the time to start looking at some great quality companies such as NextDC, Altium, Aconex. There's a plethora out there that have corrected between 20 and 30% where there's no change to fundamentals whatsoever. So you genuinely have to take a 3 to 5 year view on some of these names, but we think you'll be well rewarded with the growth that will come out over time. We always wonder how you get a great quality company at a good price, and it's normally when you see a capital rotation like this or some other anomaly in the market that causes a bit of dysfunction and a bit of disequilibrium, and that's up to us to exploit on a 3 to 5 year view and not worry about the next 3 months.